Hello to everyone. My name is Adriana Calderon, and I will be speaking to you today about the importance of transfer pricing in Singapore. So first of all, let me introduce our firm. Our firm is Transfer Pricing Solutions Asia that specializes in providing practical, proactive, and cost-effective transfer pricing advisory with offices in Australia, Singapore, and Malaysia. I'm the lead partner based in Singapore with 15 years of experience in transfer pricing across a broad range of industries, business models, and type of transactions. So let's start by going through a small case study, which is a good example of the typical situations that we face when it comes to transfer pricing. So a manufacturer with operations in Singapore and Malaysia. The big problem is that the Malaysia entity was overpaying tax and leaving excessive profits in Malaysia due to mispricing on the sales from Malaysia to Singapore. The misprice incurred over 3 years, increasing the tax bill for the group. So what solution did we propose? Thanks to our advice, the manufacturer was able to reduce the excessive profit and tax paid in Malaysia because it was basically overpaying due to a misprice. We were able to minimize the group tax bill. The main mistake was related to mispricing that roll over from year to year, and therefore it was crucial to identify mispricing as soon as possible to better manage the transfer pricing risk. So why is it important that your client is aware of the need of TP documentation and managing the transfer pricing risk? So point number one is transfer pricing documentation is mandatory in Singapore since 2018. The arm's length principle applies to all Singapore taxpayers that entered into control transactions in Singapore. Transfer pricing documentation assists with compliance with the arm's length principle, and it can also assist with making sure that there is no mispricing issues that can increase the group tax bill. It reduces the risk of audit and disputes with IRS. It helps explaining the taxpayer's position with IRS and minimizing penalties in the event of a transfer pricing adjustment. And as an overall comment, it is recognized as a good practice by tax authorities. So what is the scope of transfer pricing in Singapore and in most countries in the region? Transfer pricing refers to the price at which a transaction between companies of the same group take place. So the arm's length principle is a standard principle that needs to be followed by multinational companies. The two main issues that we try to address is the substance of the arrangement and whether the price is an arm's length. In transfer pricing, we are basically testing generally prices within a transaction. The most common transactions that you can encounter within multinational groups can be grouped in four main groups. Tangible property, which involves the sales and purchase of goods and spare parts, intangible property and royalties, services, loans, and financial arrangements. So what are the main triggers whereby a multinational needs to look at transfer pricing? The first trigger could be business with operations overseas, whether it is subsidiary or branches. Business with domestic operations with via various subsidiaries or branches under tax incentives. Why? Because in Singapore we have domestic transfer pricing if the groups of entities are subject to a different tax rate. So some examples of our most common tax incentives are global exporter, shipping, asset management, and they all have to comply with the arm's length principle. What are the key compliance requirements in Singapore for transfer pricing? So we have that in the tax return, taxpayers will have to complete a related party form when their transactions, both domestic and international, exceed 15 million Singapore dollar during the year of assessment. And we also have transfer pricing documentation that can be in the form of a master file, a local file, and country by country reporting for certain taxpayers. So what is the risk to your client? Transfer pricing adjustments and double taxation are a significant risk that can increase the multinational group tax bill. Singapore taxpayers can face the following consequences: non-compliance penalties for not preparing TP documentation, non-compliance with the ARMS principal surcharge of 5% on the TP adjustment. It will not be possible to perform a year-end adjustment or retrospective adjustments if the client doesn't have transfer pricing documentation, and it's not possible to request assistance from tax authority in the event of a double taxation issue. How can our firm help? We have vast experience in providing transfer pricing advice. We can help with preparation of global transfer pricing documentation, group master file, local transfer pricing documentation, regional transfer pricing documentation, transfer pricing documentation updates, transfer pricing planning, transfer pricing contracts, and also benchmarkings locally, regional, and global. So if you want to partner with us, please feel free to contact us via email, visit our website, and follow us in our social media channels, LinkedIn, Facebook, YouTube, and Twitter. Thank you.